Welcome back, traders and investors. We do have some news hitting the tape. We have a new CFO for Twitter coming from Goldman Sachs, and the street is liking this. Dennis was predicting taking out the $42 level. That bit of news has taken the stock over 42. But online here, we have Peter Tuz, and he is president and director at Chase Growth and Chase Midcap Growth Funds. He earned his degree from Ripon College and a master's from University of Missouri and an MBA from Tulane. Peter, how are you doing this morning?
I'm doing well, thanks. How are you?
We're doing good on this Tuesday. Short week here. We're
Sure.
glad to have you on. Now we're getting some good people here from a very respected firm like Chase here. But let's get right into the markets and. Had the end of the quarter window dressing yesterday. Did you see any discernible trends in the end of the quarter?
Not a great deal of discernible trends. One thing I noticed, Apple was up 1% or so yesterday, and one of the things that struck me was the prior Friday Russell rebalances its indexes, and Apple's weighting increased in the Russell Growth Index substantially, so that probably prompted some further buying yesterday. A few other stocks had slight moves, probably more than normal, but I thought the window dressing this time was relatively minor.
Yeah, pretty muted. So really nothing done on either side of the market. I know I was talking about this with Dennis yesterday that a lot of the companies that were going in that you expected to rally actually declined, and then vice versa with the ones that were deleted. Did you notice that at all?
No, I did not. But to tell you the truth, I don't spend a whole lot of time worrying about window dressing one way or another.
Okay.
We tend to be long-term investors, and what happens at the end of 1 month or 1 quarter is curious to me, but not that important.
Okay, not on your radar. So, are you strictly do fundamental analysis on stocks, or do you?
No, not at all. We have a process, and we've had it for the company was founded in 1957. We've had a process that combined fundamental, technical, and quantitative indicators for 4 decades, 5 decades now. And I would say that the fundamental aspects of a company, its earnings history, its earnings consistency, its return on its capital, and its balance sheet strength are about 50-60% of our process, and various technical indicators and quantitative indicators are 40-50% of our process.
Wow, well, kind of a diversified approach there. So, tell us about the technical indicators that you look at.
We use a combination of 8 technical and quantitative indicators, and about half of them are, I'm going to say, relative strength related. We like to see how a stock is doing versus the market, and time frame that's important to us is really not the short-term time frame, 30 days, but really the 90-day-ish time frame. We like to see stocks that are starting to outperform the market, and relative strength is our tool for that. The other technical indicators that we pay a lot of attention to are simply the 50 and 200-day moving averages of a stock's price.
So you mentioned a 90-day time frame. Is that when you reevaluate what you have in your portfolio?
Well, we're reevaluating what we have in our portfolio weekly or daily. But this is kind of like football. This is this game of quarters. So quarters are roughly 90 days long. So we like to see the great majority of our stocks showing positive relative strength, improving relative strength versus the market over a quarterly period. It means that we're in the right groups, the right sectors, and the right stocks.
But you will you're holding the investments for much longer term.
Oh, yeah. Our average holding period, our turnover is roughly 100% per year. So,
100%?
Yeah, 100% per year. So, which is fairly typical for a growth manager like us. So we tend to hold the stock about a year.
And what are your keys to when a company stops growing?
Repeat the last part of your question.
Just like you're in growth companies here, and the growth companies are afforded very high PEs based on future growth and for continuing. Do you look for stalling out patterns or percentage increases?
There's two parts to your question. One is, I know we're in growth companies. We consider ourselves GARP managers, but if you look at our PE right now on 2014 EPS, it's only about 16. It's actually a little lower than the Russell Growth benchmark. So we are in names that are showing, if we're right, our earnings growth for our portfolio companies, about 40 of them in large cap, should be about 20% this year, and we're paying 15, 16 times earnings. So we're not paying up for growth. Secondly, and you are exactly right, one of the key measures, there are four reasons why we sell a stock. One is it hits our target price. Two is a deterioration in the fundamentals, i.e., if the growth rate starts to slow or a company misses an earnings estimate or is light on revenues, we'll reevaluate the reasons why we hold the stock and quite often start to pare it back some. We also sell if the technical profile, which I was just mentioning, if the relative strength starts to deteriorate, and if the stock starts to weaken versus its moving averages, and lastly, we'll sell when we find a more attractive stock than the weakest one in the portfolio.
Great criteria for evaluating a stock's performance. So what's your outlook for this quarter? Nice move in the S&P and the benchmark indexes. Just a slow roll up here. Are you expecting more of the same in the third quarter?
Yeah, a slow roll up would probably be the most likely thing that's going to happen. I'm going to put a couple of big caveats on it, and beginning next week, the week after next, we're starting to go into second quarter earnings season, and I think it's going to be very important for three things to happen: companies to meet or beat their earnings expectations, companies to show some revenue growth, and lastly, the guidance to be that company officials give to have a positive tone to it. We've just finished the second quarter was good for the stock market, but the numbers we got regarding the economy last week, that negative 6% GDP number, 2.9% GDP number, for the first quarter was horrible. So we want to see signs that the economy grew in the second quarter, and it's reflected in companies' results. If we don't get those earnings, and if we get weak guidance and a sign that the second quarter economy wasn't all that strong, I would not be surprised by a sell-off. But interest rates are low. There's a lot of liquidity out there. There's a lot of M&A activity. There are plenty of drivers to keep pushing the stock market up as we go into the second half of the year.
Last quarter, there was a lot of bottom fishing. A lot of tech stocks came off hard. I'm not sure if they saw it in the stocks that you owned. And, boy, the street was there to scoop them up. Is that part of your strategy? Will this trend continue? What's your take on it?
No, we're not bottom fishers. We are basically looking for companies that are doing well both fundamentally and technically. We just have never been able to successfully time picking the bottom for an equity. So, we like to see a company that's already showing improvement both as a stock and strong results as a company.
Do you have some favorite and least favorite sectors for the upcoming quarter as well as the rest of the year?
If you bear with me for a second.
Sure, no problem. Just give a quick update. S&P's 500 futures, 1 point away from its all-time high, 1960. That's the only resistance we have in the book here. Dow Jones trading up nearly 70 points here, 2 minutes into the session.
Well, we are roughly today 22% of our portfolio is in technology stocks. That would continue to be a favorite of ours. 17% is in healthcare equities, again a favorite, and 15% in consumer discretionary.
Okay, so and can you mention any specific issues that perhaps you're looking to enter into this quarter, or perhaps
Well,
exit?
in the large cap, I always like to give people the most recent purchases
Great, that'd
that
be
we've made,
fantastic.
and in the large cap sector, actually it was a financial. We added to Ameriprise Financial, the insurance and investment management company. We added to Fiserv, which is a technology company, but it is primarily doing work for financial institutions. And in our mid-cap fund, the Chase Mid-Cap Growth Fund, Waste Connections, a waste management firm, were the last three purchases we made.
Okay, and any
All in the June 25th time frame.
Okay, and
by the way,
and any exits?
any exits? We exited Chicago Bridge and Iron.
Oh yeah.
A large construction company involved in petrochemical plants and the like, and it's a good reason. The stock was breaking down in our process, both fundamentally and technically. And in the mid-cap portfolio, we exited a company called Maztec, which is again, a construction company. Does a lot of work with telecommunications companies such as AT&T and pipelines. Again, for both fundamental and technical reasons, AT&T had delayed building some wireless towers, and that hurt Maztec. Two most recent sells.
What's the symbol on Maztec?
MTZ.
MTZ. Okay, that Chicago Bridge and Iron. Yeah, the charts both look similar on those.
Yeah, they have a pretty good downward slope to them, and that caused it to violate many of the technical indicators that we watch. Coupled by some fundamental deterioration, and I cut our losses and look for something with a little bit more promise near term. Both of them are good companies. We just, they're just undergoing hiccups right now.
Okay. Do you keep any black swan protection on your portfolios, or do anything in the options market?
No, we are pretty traditional, long only. We feel like we have a lot of risk control measures by picking high quality companies. We generally, not always, but we generally have a beta around the benchmark. But except for very unusual situations, we don't get involved with options. For some of our individuals who have very low cost basis in a stock that they might bring to us, we might use some options to protect them from the downside there.
Okay, and so what best advice can you give both new and old investors? I mean, people now reaching their start with them. People that are reaching their their earning capacity now. What kind of advice would you have for them for investing?
Yeah, I think the first bit of advice would be to start as early as reasonably possible, because the power of compounding works magic the longer you give it. The second bit of advice would be first to take advantage of all the tax advantage plans, employer matches that you can get. You get a great help from the government and your employer in getting started. And thirdly, it'd be I guess to have a consistent plan. So many of us see individual investors jump into the market when the market reaches an all-time high, only to sell out of the market when they see a swoon in the market. So, it'd be to have an asset allocation plan, be it 60-40 equities fixed, or 70-30, or 80-20, depending on the age and the risk tolerance, and stick with that. Rebalance a couple times a year, but don't try to time exits and entries in the equity market. It's just difficult to do over time.
And just we talked about, the long-term perspective. Obviously, there's nothing technically in this market that's going to say that we're turning around. So you're focusing on perhaps the fundamentals next quarter to see that if the earnings are going to show a difference. You were a little bit troubled by that GDP number, but you feel
Yeah.
if earnings come out strong this quarter, it will kind of, because a lot of people were looking at that as a blip in the GDP. You're looking to see if the companies can confirm that we are at least going to have a little bit better growth.
Exactly. Yeah, I think better than expected earnings, continued low interest rates, a lot of liquidity out there, a lot of M&A activity could continue to push the market higher. But if there's one thing that worries me, it would be that that first quarter blip down in GDP will scare some people, and it'll be reflected in a weaker economy going forward.
Okay, we'll be looking out for the earnings next quarter. Well, we've had Peter Tuzon, President of Director of Chase Growth and Chase Midcap Growth Funds, giving us his diversified approach to the market. I like you throw the fundamentals in there as well as the technicals and your quantitative indicators. Obviously, have kept you in this great bull market. Peter, thanks for coming on. Have a great 4th of July, and we hope to speak to you soon.
My pleasure. Thank you for your time.